Your brand new iPhone deserves the best protection, and the iLune 3-Pack Screen Protector plus 3-Pack Camera Lens Protector has you covered. Don't take risks with your iPhone. Click the link in the video description to shop now on Amazon.
Welcome to Quora, where we dive into the latest market trends and strategies that can help you navigate the ever-changing world of finance. The S&P 500 has been making headlines lately as it nears levels not seen since the dot-com bubble. But instead of running scared, Wall Street is taking a more nuanced approach. Strategists across the board are questioning what counts as normal in this market, and valuations that once screamed danger are now being treated as the new standard. One key reason for this shift is the dominance of tech giants in driving both market cap and earnings growth. As Savita Subramanian, equity strategist at Bank of America, notes, maybe it's time to accept these high stock multiples as the new baseline. By anchoring to today's multiples rather than expecting mean reversion to a bygone era, we can get a better understanding of what's driving these valuations. Take a look at the S&P 500's forward price-to-earnings ratio, which now stands at 22.8. While that might seem high, it still trails the 25 high just before the 1999 meltdown. The key difference this time around is that tech and communication services stocks make up a much larger percentage of the index's value, contributing over 37% of earnings. In contrast, during the original dot-com surge, they made up just 23% of the S&P 500's value. So what does this mean for investors? Sam Stovall, chief investment strategist at CFRA Research, points out that when measured over just the last 5 years, the gap between the S&P 500's forward price-to-earnings ratio and its long-term average drops to a high single-digit level. This suggests that the market is no longer running on fear and greed, but rather on solid earnings growth and a strong economy. The Federal Reserve has also taken notice of the heat in the markets, with Chair Jerome Powell warning last week that markets look fairly highly valued. However, unlike Alan Greenspan's 1996 irrational exuberance speech, which was delivered just before the bubble burst, most strategists aren't seeing this as a bubble. Instead, they're looking at earnings and seeing something different this time around. Ed Yardeni, a veteran market analyst, notes that while the S&P 500's forward price-to-earnings ratio is indeed high, it still trails the 25 high just before the 1999 meltdown. And when we look at the contribution of tech and communication services stocks to the index's value and earnings, we see a narrowing gap between past and present. So what's the takeaway for investors? Gene Goldman, chief investment officer at Cetera Financial Group, believes that 2025 has been a big year, but that doesn't mean a crash is coming. Instead, he expects some type of market pullback, maybe 3% or 5%. But these dips could be buy-the-dip opportunities, and with earnings forecasts for 2026 looking solid and more rate cuts from the Fed expected, the stock market could stay expensive for a while. The bigger risk, in Goldman's view, is the possibility of a melt-up, a surge caused by fear of missing out. We do risk a melt-up where everyone jumps in and buys aggressively, he says. So how can investors avoid falling prey to this? By understanding what's really driving today's valuations, rather than comparing them to the past. That's all for today on Quora. Thanks for joining me in exploring the latest market trends and strategies. Until next time, stay informed and keep investing wisely.